Welcome to my accounting classroom. I'm Sid Bundy, and today is going to look a little different. I'm going to tell you a little story and use it as an example for how transactions can be recorded in T accounts, adjusted, and used to build an income statement and balance sheet, all in 7 minutes. Let's go. This is Michael. Michael's 15 and loves gaming. He wants to upgrade his system but only has $200. He decides that he needs a job this summer to earn the money. He faces two problems. One, he doesn't have a driver's license or a car. Two, the pandemic shut everything down and few places are hiring teens. So Michael decides to open a mowing business. His dad gives him an old mower, weed eater, and gas can. It's one of those dad things to give $1,200 toward an idea rather than just buying the stuff he wants. He also gives him a lot of advice about running a business. He sets up a basic ledger and shows Michael how to record the $1,200 mower as a gift to equity. Michael's Mowing is born. Michael talks to his neighbors, and one lady gives him $100 in advance to cut her lawn 4 times during the summer. He records the $100 as unearned fees because he hasn't done the work yet. He spends $8 to fill up his gas can, and then he mows her grass for the first time. He records the $8 purchase as a credit to cash and a debit to supplies. And now that he's done the work, he can recognize $25 of the unearned fees by taking them out of unearned fees and putting them in to Mowing Revenue. He snaps a photo while he's mowing and his parents post it on social media to advertise his services to their friends. He makes a logo and orders business cards for $20. When they come in, he'll leave the cards with other neighbors. The social media posts didn't cost him anything, and he decides to categorize the business cards as a supply. A family friend calls and asks him to mow for $30. They're on vacation this week, so they can't pay him right away, but he mows anyway, and he texts them a photo of the finished yard as a reminder to pay him. He records the revenue because he's done the work, but instead of debiting cash, he debits accounts receivable. Let's fast forward to the summer where Michael continues to mow grass. He works hard, his clients love him and recommend him to friends. Soon, he has a full schedule with many regulars. Each time he finishes a yard, he recognizes revenue by increasing the Mowing Revenue account on the credit side. He keeps his appointment with his neighbor who prepaid and recognizes another $25 of the unearned fees. He also cuts another yard on account for $50, so he sets up another receivable for $50. As summer continues, Michael cuts grass and collects $20 to $50 lots of times. To save space on this example, I'll record $1,700 worth of credits to revenue and debits to cash. I'll also show where he finished up the agreement with his first client. She hired him again with another $100 advance. Michael didn't send formal invoices this season. Maybe he'll start doing that next year, so collecting the accounts wasn't easy. Still, he collects from the family friend and accepts partial payment on the other account. He also uses more gas. He has to do some light maintenance and he buys some weed eater string. Most of it he can do for himself, but he ends up with a $150 bill with a small motor repair shop. He estimates that the equipment will probably last another 3 years, at least until he leaves for college, so he doesn't plan to save any money to replace the equipment next year. Both of these items are treated as ordinary operating expenses. They don't cost very much, and they don't extend the life of the equipment. Michael sets up a payable for the repair shop when he gets the bill. Michael can use some simple accounting to determine how much his company earned this summer, how much he can withdraw to buy his new PC, and how much equity he has built. Fortunately, he lives with 2 CPAs who can help him set up his books. At this point, Michael has recorded all of the ordinary transactions. He's calculated preliminary balances for each of the accounts, and it's time to look them over and make necessary adjustments. He notices that the supplies account currently shows that he bought $98 of supplies, but he doesn't still have all of that fuel, and he's given away most of the business cards. He also sees some unused accounts related to depreciation and asks about those. We estimate that only $5 worth of supplies remain. I help him adjust the supplies account by calculating supplies expense as the difference between what he's purchased and what he has left. We credit the supply asset account to adjust the balance and debit supplies expense.
Depreciation is a whole other ballgame. I don't really want to get into the accounting standards and estimates, so we do a quick straight line calculation for the portion of the equipment that was used up. No salvage value. He plans to use the mower for 4 seasons, so he writes off 1/4 of his basis at the end of each season, recording the expense as a debit and writing down the asset through a contra account. A quick tip to remember this particularly troublesome entry is that the order is DEAD, D-E-A-D. Depreciation expense, D-E, then accumulated depreciation, A-D. He updates the balances, and then we write out 2 financial statements, the income statement and balance sheet. A simple income statement lists the revenue and expense accounts and then subtracts to get net income. Michael's mowing earned $1,542. The balance sheet proves the accounting equation. Asset account balances are listed on the left. Liabilities and equities are listed on the right. Notice the calculation for the capital account. It's the $1,200 initial investment plus net income. It's tempting to say that the company is worth, but that's a little misleading. First, that amount is based on an estimate for depreciation on equipment. Second, it doesn't give any value to his reputation or his client list. Capital would decrease if Michael took out any money, but Michael didn't take out any money. Wait, don't you want to take out money to buy your PC? Wasn't that the point of working? Notice that the cash balance is higher than net income. That's because Michael hasn't paid his repair bill yet, and, recording depreciation expense, decreased income without decreasing cash. We recommend that Michael take $1,500 out for his use. That's almost all of the profit for this season, and leave $547 in the cash account. Now he's set up with a little bit of an emergency fund or expansion fund for next season. I update cash and total assets and recalculate his capital balance. So that's it. The first season for Michael's mowing is in the books. Michael is a successful entrepreneur, and he's happily gaming on his new system. Now, who's going to tell him about taxes?